All right, so yeah, my name is Micah Cameron-Harp. This is some work I've been doing with my advisor, Nathan Hendricks. I appreciate the comment that I'm down to earth. I've worked hard to have that reputation. So today I'm going to talk a little bit about carbon credit markets, give just a very broad view. Then we're going to talk a little bit specifically about what somebody who's buying those credits might be looking out for. And then finally, some future considerations. And the goal here is so that if somebody comes up to you and asks you, hey, what's the deal with carbon credits? I saw this commercial on TV. Indigo has been putting up some commercials on YouTube recently for their carbon program. What do I need to know so that you'll have some ideas there from a variety of perspectives, and then maybe a little bit more in-depth knowledge about what a producer should be thinking about as they make the decision about whether they should participate. Okay, so where we want to start is who's paying for carbon credits and why? Why is this blown up? Why are we now looking at a nationwide opportunity to participate in these markets? And the short answer is that this is really ballooned out of this corporate social responsibility efforts. So we have companies like Cargill, PepsiCo, and Microsoft making these pledges. They've said, hey, we are looking at our supply chain. We think there are however many tons of carbon being emitted because of our operations. And we are going to now offset that or try to sequester the carbon that's been emitted. So because of that, there's now this huge demand that's exploded in recent years for carbon credits. And agricultural producers have a chance to participate in that market. So the structure of this market, for the most part right now, it's an entirely private market that consists of buyers like these corporations, and then also individuals as well, which I'll come back to. We have intermediaries, which are the names you might recognize: Nori, Indigo. Somebody mentioned Truterra now has some projects in Kansas going on. And then we have the sellers, which are the agricultural producers here in Kansas. So the buyers are going to be one of these companies that's trying to offset their emissions or perhaps sequester carbon that's related to their operations. The intermediary, their job is really to quantify the carbon that's being sequestered and then to find a buyer for it. And then we have the producers themselves who are going to adopt some type of practice or change a cropping rotation perhaps to generate these carbon credits. All right, so how big is current demand? Well, for 2020, there are about 93 million carbon credits purchased. The carbon credit in general is a credit's worth about a ton of CO2 stored in the soil. $15 a credit, that's roughly $1.4 billion, so a pretty decent chunk of change. And that volume of sales is only increasing over time, going up by 33% since 2019. One stat that I think gives an idea of the relative share of agriculturally produced carbon credits is that Microsoft, they contracted for about 1.3 million metric tons in 2021, and about a sixth of those were purchased from agricultural producers. So a decent size chunk of those credits that they're purchasing coming from the ag sector, and that's only growing over time as programs like Indigo and Nori start to take off. The other opportunity for the sector that I see growing right now is individual demand for carbon credits as well. I'm not sure if you guys have been on Google Flights recently. I'm not sure when I took this picture, but now next to all your flights, it puts the emissions of CO2. And we see some individuals going out and purchasing carbon credits to offset their individual emissions as well. The big concern from the perspective of a buyer is, how do I know that when I buy that carbon credit, there's actually a ton of CO2 stuck in the soil somewhere? And there are really four ways that we can think about this quality assurance problem. The first is additionality, the second, permanence, third, leakage, and the fourth is uncertainty. And when somebody brings up a concern about carbon credits, either the quality of them or whether or not they should participate, it usually relates to one of these four areas here. Additionality has to do with whether or not there is actually a practice being adopted which would lead to some change in the soil carbon sequestration rate. The example I have here is if you have a forested piece of land and then it continues being forested in 2021, no carbon credits are going to be issued in that case in most circumstances because there was no change in the cropping practice which would lead to an additional unit of carbon being stuck in the soil. Versus if you had, let's say, cropland and retired it and turned it into forested land, then we would say there's been some change in practice which would increase the carbon sequestration rate. This example here of retiring cropland is in general not commonly covered practice in carbon credit markets, and we'll talk about that when we get to the leakage concern. So the second area of concern here is this idea of permanence. The carbon is usually bound in organic forms in the soil, and I'll let the folks from agronomy correct me if I'm wrong, but it degrades over time unless it's in one of these mineralized forms. So there is a concern about how long the carbon I purchase as a buyer, let's say I pay 15 bucks a ton for it. Am I buying carbon that's only going to be around for the next 10 or 20 years? And that's a legitimate concern when you get onto the scale of a company like Microsoft, who's going to be spending a couple $1 million per year on these carbon credits. Are they paying to offset carbon for the next 10 years, or is it truly sequestering the carbon that they emitted indefinitely in the soil? All right, the third concern is leakage, and the reason why I like bringing up this idea of retiring cropland is because if we take land out of cropland here, there's a chance that elsewhere, the very common example is in Brazil, somebody then cuts down forest and puts it into cropland. That's why we don't see things like a CRP program. The equivalent of that doesn't exist in carbon credit markets. Because there's nothing to say that we retire cropland in the US, somewhere they're going to cut down rainforest, which is going to emit in aggregate much more carbon than perhaps we sequester by retiring cropland. So instead we see programs that focus on things like cover cropping or no-till, right? To keep the total number of acres the same, but instead change some practice so that on a per acre basis, we're now sequestering more carbon in the soil. The leakage is another one of these kind of concerns that we see mostly played out in the type of covered practices you see in these programs. All right, and then the last one is uncertainty. And this is one to me which is really fascinating because within a single field, I was talking earlier about being in soil science class, and we had to go and walk a transect where you pull a soil sample and then you walk 10 feet and you pull another one. Ton of fun. Had a blast doing it. And then you go and you run everything in the lab, and the chances of you pulling a soil sample, walking 10 feet away, pulling another soil sample, and finding similar soil organic carbon values, right, I see some people shaking their heads, pretty low. If you walk 30 feet away, your chances of finding similar carbon values are almost negligible, right? But we are going to say on a per acre basis what the carbon sequestration rate is and pay a producer accordingly. So this question of uncertainty becomes really important when it translates into somebody's bottom line, right? Or what they're expecting as far as the return on their investment of participation. Give you an idea of how this might play out in a particular program. I bought some carbon credits. So these are from Nori, and I think it does a good job of demonstrating how you might address these four issues. So the first is that they're going to say the exact producer and the means of quantification right here. So that gives me an idea of the uncertainty that's involved. The other one is it's going to tell me the practices that are involved and where those credits are generated. So I can be assured of the additionality and the leakage aspects as well. And I think overall, just as a consumer, this kind of lets me know, hey, what I'm purchasing, I know where it is, what was involved in the practice of sequestering it, and perhaps what the uncertainty bounds are there as well. Doesn't really assure me that somewhere in the Amazon, somebody isn't cutting down however many acres of forest, but I think the fact that you can look at this plot of land and they tell you what is occurring as far as a change in practice, you can infer that, hopefully. Okay, so as I said, uncertainty as an economist is really interesting. And so what I did is I took some estimates of what certain practices would do as far as sequestering soil carbon, and then attached a price to them on a per acre per year basis. And I looked at how wide the spread might be. So in this first 2 rows right here, I compare the exact same practice adoption, no-till, but I look at what might happen if you have a slightly different soil type. So you see the first one, no-till, warm, dry climate, but we have this loamy, silty, or clayey soil. The second one, we have a sandy soil, all other conditions held the same. It's about 55, well, it's exactly 55 cent per acre per year difference, which can make a pretty sizable difference once you scale up the operation. But we instead look at an operation that has already adopted cover cropping. It's considering including no-till. And what we do is we vary the crop rotation instead. This is a $4 per acre per year spread, which is massive in terms of the variation. And this is in a single location and one decision for one operation. So when somebody asks me, hey, should I be participating in carbon credit markets? My first answer is always, what are you doing right now? What does your soil type look like? What does your climate look like? Because without those answers, it could be not worth your time, right? $3.85 per acre per year for you to compile all of your production history for the past 5 years and comply with a contractual obligation for the next 20 years. That's a lot of time and effort. Maybe it's not really worth it. Versus, $12.25 per acre per year, especially if you've already got all your production history entered into granular or some type of software that tracks it. That could be worthwhile. All right. Well, what happens? Let's say you do decide to go with one of these programs. You think the return on your investment's worthwhile. What's the next step? Well, the majority of intermediaries take this model and measure approach. So what they're going to do is they're going to take your production history, or they're going to look at where you're producing, the soils involved. They're going to throw it into some insanely complicated process-based model, which I contemplated investigating in the beginning of my PhD, but I think I would need to do another PhD just to understand one of them. So I have no intention of doing that. So they're going to put all the data in here, and it's going to spit out, hey, on a per acre basis, we think you're going to be sequestering, let's see, 0.2 tons of CO2 per acre per year. As a producer, in some of these programs, you would have the option to say, all right, great, that sounds awesome. At $15 a carbon credit, I'm okay with that. But let's say perhaps you think their model is wrong. What do you do? In some of the programs, the answer is nothing. You can't do anything. That's what you're going to get. In other ones, you have the opportunity to supplement their model with soil samples that you take. So another question I always ask producers is, well, do you already have a gridded soil sampling program? Do you already have data that if they say, hey, you're only sequestering 0.2 tons of carbon per acre per year, you can say, hey, whoa, hold up. I have the soil samples which show that it's actually 3 times that. That can be a reason why you would pick one of these programs over another as well. Okay, so in Kansas, just to give you 3 examples of what that might look like, I put up three different programs here. Bayer, their carbon program, Carbon by Indigo, and then NORI. And I think these are by no means all of the carbon programs available in Kansas at the moment, but they do a great job of showing some variation, and some really important variation for producers. So Bayer's program, if you look at their eligibility criteria, it's very specific. Cover cropping, no-till, or both. You have just some farm management records, doesn't have to be for a specific amount of time. You enroll in their climate, field view platform, and they are very unclear about how those credits are quantified. Indigo, very similar practice list that's covered, but they also include things like nutrient management or changes to your applications of animal waste. The data requirement is much higher, right? 3 to 5 years of historical data, and that's incredibly involved. Soil sampling is optional, and they're very clear about how they end up doing their quantification. NORI has probably the most extensive cover practice list out of all of them. Again, 3 to 5 years of farm management records, and then they use this Comet Farm tool, which is kind of nice. You can go and play with it online if you like, and toy around with what happens if I change my nutrient application or something like that. Well, why does this variation matter? And I think one of the really important reasons to me as an economist is that the risk profile for each of them is different, as is the compensation. So NORI right now, you get $15 per carbon removal ton. Those carbon credits that you generate in NORI's program are held by the producer. So the producer receives some carbon credits, and that is now their asset, right? And they can sell them on the marketplace as they wish. Versus Bayer's program. Bayer instead is going to give you $3 per acre per year for no-till, $6 for cover cropping, $9 for adopting both on a per acre basis. The producer in that case does not hold the carbon credits at the end of the day, Bayer does. So all the riskiness associated with whether or not the carbon market completely collapses, let's say in 2 years, or it explodes, is held by Bayer rather than the producer themselves. That also means, though, that if you're a producer who has a very high carbon sequestration potential, in Bayer's program, Bayer is the one who's going to profit off of that, right? Because they're going to pay you $9 per acre, when in reality, if you went with a program that paid you on a per unit carbon basis, making $15 per acre. The last thing I'll mention here is this idea of transaction costs. So I mentioned earlier, there's an opportunity with some of these programs to do gridded soil sampling, or with all of them, there's a requirement that you submit your production data. Both of those things are cost borne by the producer, right? Whether it's time involved in compiling massive amounts of data, or it's actually paying for the gridded soil sampling itself. So in some of these, I think it really comes down to, what do you think your expected return is going to be? And is it worth the effort to try to increase that expected return by maybe pulling some extra soil samples, right? Or compiling the data necessary to enroll in one of these programs, which lets you take advantage of your local production conditions. So some important questions that I encourage everybody who is either advising somebody about carbon credits to ask, or the producers themselves. The number one question is, who owns the credits at the end of the day? So when people ask me what I think is going to happen to carbon credit markets, my honest answer is I am not sure. Right? This is not the first time we've tried to establish a carbon market in the United States. There are a lot of signs that this is going to be successful. One of the most encouraging to me, I'll get to in a second here, is that there's a lot of bipartisan support for some legislation at the national level. That being said, depending on the program you participate in, you may be the one on the hook if the carbon credit market collapses as the producer. And so right now we have this price floor, $15 per credit for nori, and it's $10 for indigo. But that may not always be the case if we let these markets operate freely. The other reason I asked this question is that it highlights the fact that carbon credits right now are a diversified product. It's not a commodity. If I buy carbon credits from nori, there's nothing saying that that $10 worth of carbon credits in nori is worth $10 of carbon credits from indigo, because they're quantifying the carbon sequestration differently. And so it isn't the case right now that I can really prospect on what these carbon credits are going to do in general. Instead, you have to think about, what do I anticipate nori's carbon credits are going to do if I enroll in nori's program? And that is a tough problem for the consumer of these carbon credits, or somebody who wants to use them as an investment tool. But I think it's also advantageous to producers in some ways, because it allows you to pick the program which perhaps best fits your operation and your local conditions as well. So the upside of a program like Bayer's, which we call pay for practice, is that even if you're going to be sequestering very little carbon in your soil, the payoff is known and guaranteed to be the same regardless. Second question is, what happens with the data? So I mentioned with some of these programs, you're sharing 3 to 5 years worth of production data. Can the company then resell that data to somebody else? It's a very valid question and a concerning one. The answer differs depending on the program. For some of them, they say explicitly that they can share the data with anybody who has a financial interest in their company, which to me is an extremely broad sweeping statement. To let's say nori's case, they say that the data can only be used for the purposes of quantifying the carbon that is sequestered in your operation soil. So thinking about what the terms of those agreements are, I think that to me is another really important aspect. And then finally, how long does a field have to be enrolled in a program? And what happens if that can't be the case? So what happens if you have to break the terms of your contract? This also varies significantly from program to program. In general, it's about a 10-year contract that most of these programs are signing you up for, with an additional 10 years of kind of a good faith agreement that says you're not going to do anything which would lead to the carbon being sequestered in the first 10 years being released. That's a long time in, I guess, our human lifespan. In the soils world, it's, a blink of an eye. So there were many people advocating for 100-year contracts, and that, as I'm sure you can imagine, didn't fly. So 10 years is where things stand right now. And there are some questions there that I think are worth asking. What does that contract actually stipulate for the next 10 years? Is that going to lock me into cover cropping when perhaps glyphosate resistance becomes a huge problem, right? Or I have a colleague at K-State who's looking at wheat streak virus, which can overwinter in some of these cover crops. So if something like that blows up, and now I'm stuck doing a practice which could be very costly or increase my input costs, what do I do? Those are very important questions. And in some of the programs, you can break your contract, and essentially the carbon credits that you generated are then withheld. So aside from the lost revenue from those carbon credits, there isn't some type of financial penalty which is imposed on you. The other reason I like to talk about this contract length is that it brings up kind of future of this program as well. So I mentioned briefly, we have the Growing Climate Solutions Act of 2021, which will soon become 2022. And it has a really surprising coalition behind it. It's really bipartisan. And it has kind of two major arms. The first is to help with verification. And the second is to actually assist producers themselves. So the idea being that perhaps we bring down some of the fixed costs of participating, make it easier for producers to enter these markets. The other one is to address some of these things like the variation in what your potential return might be. So I like to bring that up because it could change some of the incentives involved. The amount of, I think it's $40 million that's behind it right now, or 400 million, regardless of which one of those numbers it is. I'll get back to you on that. It's not enough where we would see them actually setting up some type of carbon bank. Instead, it would be something where they're trying to train local verification parties. Second concern, what if the cost of carbon increases? So right now we're sitting at $15 per carbon removal ton. That's probably the general price. In the EU, they're trading at up to $55 per ton. And I heard recently, so 68 was the highest I saw go in May. But somebody, one of the other students in our department was saying he saw them trading at 72. So if you think about the possibility of, let's say, this Growing Climate Solutions Act standardizing carbon credit quantification to the point where we could sell our carbon credits from the US in the EU compliance market, where they are regulated to have a certain amount of carbon reductions, that is a massive difference in the per acre return for a producer. I have some other examples here of upcoming markets. The last topic I want to briefly discuss, though, is discussion heard from an individual at NORI who was describing the kind of future trajectory of these carbon markets. So right now, let's say I am a producer, I enroll in NORI's program. For the next 10 years, I'm going to cover crop. My 10-year contract is up, so I have this good faith agreement for the next 10 years, or I could re-enroll in the contract again. Correct me if I'm wrong, but my soil eventually is going to saturate with carbon, right? Unless I keep adding practices. So let's say that I get to about 90% of saturation. The return from adding another practice at that point versus if I'm at 10% saturation, it's going to be much lower. So if I'm in a per unit of carbon program, profit maximizing decision may be to till my field for 2 years, empty it of carbon, and then re-enroll. And that would not be a problem with some of these current contract designs. So this is a well-known, I'm not like, spilling the beans and trying to throw a wrench into the carbon markets. This is a well-known issue. And one of the ideas is to instead pay for essentially retention of soil carbon. So it would be a massive change, but it could be very advantageous for producers who have done things like no-till since 1970. Right? At the moment, those producers cannot enroll in any of these programs because of that additionality concern. But if we switch to this retention style mindset, that would bring a lot more acreage into the carbon credit space and could lead us to a different mode of carbon market, which perhaps doesn't have these incentives to kind of flip on and off these practices. So yeah, I just want to clarify that I'm not advocating for that style of manipulation, but it is a serious concern with the way that the markets are set up. With that being said, what I'd like to do with the last couple minutes here is leave some room for questions, and I'd like to start it off with some questions from me. Does anybody here have experience, producers in their area, working with one of these intermediaries? I know I talked with some folks from Great Bend who said Truterra had a project there. Has anybody come into contact with them yet? No one? Okay. Has anyone heard from producers in the area? Have you got the question, hey, should I be thinking about enrolling in these programs? A couple of heads.
I got that question.
Yeah. What did you have? Do you have any quick answers or?
Because it was maybe a year and a half ago, and I was like,
Yeah, and I think that most people I've talked to, that's kind of where they're at too, because it's so new, right? And we don't know how long it's going to stick around. All right.
If you got something to share, I'd like you to talk into this so they can hear you online.
It wasn't so much a question, it was more of a deep, Mr. Deep. Where he left it, I was like,
Yeah.
yeah, it went, that was, yeah, they've been approached, yes, they've been tried, but they pretty much told the guys that, and I don't know if it's fair, but anyway, pretty much said highway leaked out of somebody.
Yeah. And that's, so I had a chance to lecture for an undergraduate class, and I had a student who basically had the same response, but because we were in a classroom, we didn't have to bleep anything out. But yeah, it's a legitimate concern that, you know, am I going to work and take all this time and effort to put together all these records and then essentially be sitting with, you know, nothing as a result of it. So that same person I mentioned from Great Bend, what they actually did is their who was it? It was their crop insurance agent. He said, you know, I've already got to put together all these records on a yearly basis. So what if I enter all of the data into True Tariff's platform for you? And he ended up doing that, and the producer is getting a check for $160,000 for enrolling. Not an insignificant amount of money. What I asked him was, how much time and effort do you put into that, and do you receive any compensation? The answer was a lot more than I should have, and no. So one of the areas for partnership and maybe expanding the role here is to not place the onus entirely on the producers themselves. So think about some of these opportunities like, you know, the crop insurance example, or cooperatives even, where they already are handling this data. And so that time, you know, the investment of all of their time isn't as high. I think that would be an opportunity. But, you know, whether or not this credit's going to hold up over time or the market's going to persist is, you know, a separate, I think, discussion. Yeah. Any other experiences people have had? Okay, so then this is the question I always like to ask. If I showed you my carbon credits, I'll pull it back up there. How many of you think that right now I purchased 5 tons of CO2? How many of you think that there are 5 tons of CO2 here in this operation in that plot of land? By a show of hands. 5 tons of CO2, and the acreage. This is a massive operation, but that's a good question. How large this plot is. I'm not sure. Yeah.
more than like 5 acres, is it?
I doubt it.
Tiny,
Yeah.
unless I just don't know the map scale.
I mean, this is a, yeah,
Yeah.
this is a normal traffic road.
5 acres or something?
Yeah.
You're talking 5 net tons or?
Yeah, 5 additional tons of CO2 that were generated and stored there. No way. All right, how about 5 years from now? Do you think that there's going to be 5 additional tons? No? 10?
What's the practice? Cover crop and no-till?
Yeah.
In Iowa.
Yes.
In what county, Iowa?
That's a great question. It doesn't tell me on this.
No. Yeah, it's like,
Yeah. So this is one of the reasons why I bought these. It's because I wanted to be able to have an example to say, as a consumer at this point, is this really something that is an asset that I'm purchasing, or is it something to put on my annual CSR report that goes online to my shareholders. And
Reminds me of naming a star.
yes, yeah, that's a great example. But if you think about it from the, let's say PepsiCo or one of those corporations, does it really matter to them? At what point would it matter if these tons of CO2 are actually in the soil or not? If what they're doing is purely to appease their shareholders or the consumer base, it would only matter so long as their consumers are actually concerned. And for a producer, that isn't necessarily a bad thing, right? If somebody is saying, we have this very uncertain asset that's going to be generated in your soil. We're willing to pay you for it. And the possibility of us following up and saying whether or not it actually exists or not is rather low. It sounds to me like a nice income stream. Go ahead.
So one of the reasons I asked about net carbon is because, like you say, if you put this on a shareholder annual report and your investors are looking at it, they're saying, oh, great, they went back and they bought 90% of the carbon.
Yeah.
Well, you don't buy Coca-Cola carbon, you don't buy United States carbon, you buy atmospheric carbon. So for every 1 ton of carbon you offset in the United States, there might be 10 tons of carbon being produced somewhere else that's not being offset. So this is, to me, this is such a pie in the sky deal that all you're doing is you're trying to solve a problem with money and feel good. And I hate to be pessimistic about it, but I have a lot of trouble buying this stuff as a realistic resolution to the challenge. I could see where it's advantageous to continue to add practices and promote for better soil health and that type of thing. But ultimately, if that company's not doing something within their structure to reduce, I'm not sure we're making a true dent.
Can you just summarize that for the online folks?
Sure. So the concern is that if our ability to say that the carbon is actually sequestered is so uncertain, and we're not sure if these additional units of atmospheric carbon are being sequestered, are we really solving the problem of increased carbon CO2 levels in the atmosphere, or are we instead solving a problem of a corporation being able to improve its public image? Is that a fair summary? So that's, from my perspective, the biggest concern and maybe the biggest risk towards this not working out right, is that the stated objective is to reduce global CO2 levels, but are we actually able to measure progress towards that objective? Are we able to do it on the scale that is relevant to agricultural production? And are we able to do it on a time frame which is meaningful for perhaps this global objective? And I think that those questions are all very valid questions and concerns that I share. One of the reasons why I really enjoy doing this talk is because I have a background in sustainability and in working in some of these contexts, and greenwashing is a major concern. And is this a massive greenwashing effort that conveniently pairs environmental and agricultural interests? Or is this truly a solution to reducing CO2 levels? That's a concern that I think is valid, and one that these 4 different categories or concerns of credit quality are trying to address. But I think in coming years, you'll see some movement that says, can we actually concretely make these statements that we are pulling carbon out of the atmosphere or not?
I got one other quick question. In your matrices of the different companies, there's very little, and expand that onto the other one that you didn't mention, there's very little acknowledgement of grassland carbon sinking. And so where does that play in? Because obviously there's just like tilled cropland, there's grasslands in immediate need of better management. But then take that a step further. If you think of all of the grasslands in the United States, if you go west from here, the bulk of that is public, government owned. So will they be able to participate in these programs with those
So I will say on the public side of things, I could see that happening if the government becomes interested in, some people have called it like the double tax. So if I pay tax and then that money is used to fly a senator from state California, let's say, to DC, they're emitting CO2 that whole way. So I've now paid them to fly them and then receive this additional tax of CO2. So if they become concerned with that, I could see them trying to, use the government lands, BLM lands, perhaps to offset that CO2. The grasslands concern in general, though, is one that I share, especially places like, the Flint Hills, where we have root zones which extend down to the zone where you really are going to see deeply sequestered carbon that is unlikely to be emitted in the future. To me, that's a much better carbon credit to buy. But in the current programs, they're largely ignored. So yeah, that's a downfall, I think, of the current programs. I think it's something that we could see some movement in the future as they get more popular.
Think about CRP, like, and they repeat this question, but the
Sure.
CRP, like, if any, because I think about that was one of the things that you talked about was, the example you gave of the 10 years of no-till and then, signing up versus. Is there any talk of paying people to keep CRP?
Yes. So in the context of carbon credits, if your land,
Repeat that question.
sure. So the question was, if you have your land in CRP, is there any discussion about paying to retain it in CRP so that we don't have this switching back and forth? Similar to how in the carbon markets, after your 10-year contract, perhaps we would pay you to retain that carbon instead of having you move in and out of the programs. Yes, there is discussion about that in the kind of econ literature, that it is socially optimal to pay to retain people in CRP and actually to pay a higher price because the value in terms of ecosystem services goes up over time. I haven't seen any programs, which, please correct me if I'm wrong, that would actually do that and pay, increasing rate for the amount of time that it's been retained in CRP. In the carbon market space, if you have enrolled your land in CRP up until 2000 or for some of the programs, you are not eligible to enroll it in a carbon farming program for these same additionality concerns that, you've already pumped the soil full of carbon. So in some ways, you already reaped the benefits of that. To pay you for that would be paying for no additional units of carbon that are sequestered. Yeah.
I've got one from online.
Sure.
Is there any sort of deadline for signing up for any of these programs?
Yes, if you want to sign up your historical acreage. So for some of them, acres since like 2013, or excuse me, where you've made the change in practice since 2013 are eligible. So if you're trying to claim carbon credits that were generated within the past decade, that would be the main eligibility criteria. And that's going to be program specific. And it's going to have to do with when you made that switch. Let's say you started cover cropping in 2009. For the majority of programs, that wouldn't be eligible for generating carbon credits. But if you did it more recently, it probably would be.
Anything else?
So as you have got like Great Bend numbers, Hudson numbers, have you studied enough to know if there's a dry line? Because we talk about climate being a big factor on it. So I mean, you should think rainfall, average rainfall, whatever. Is there a dry line in Kansas that can go, yeah, farther west?
Yes, so the question was, is there some dividing line in Kansas based on perhaps rainfall that would say whether or not you're going to be generating significant carbon credits or not? And let me see if I can pull it up. I went on Indigo's website. Here we go. Looked at Garden City for this reason, thinking that's pretty dry as far as Kansas goes. And these are the example numbers that they gave. So $2 for cover crop, $7 for reduced tillage, $8 for both. So it really does depend on the program and your local site conditions. What we are doing right now, so I guess stay tuned, is for a chapter of my dissertation, we're trying to make a profitability map for Kansas to say, based on your current level of soil carbon, your soil conditions, and your annual rainfall, are you in a place where we would expect your return to be very high relative to the rest of Kansas, or relatively low? So that's something we're working on at the moment. And hopefully it'll be out in March of this year. But yeah, if you want to go, play around, Indigo has, you can just, search a location in Kansas and they'll give you some estimates.
Another one from online. Did I understand that there is no carbon market for grasslands?
Currently, the majority of programs are not issuing credits for grasslands. The exception to that would be if NORI right now, their croplands methodology is the one that's published and used. They have a grassland methodology that is under review, I believe. So if that gets published, perhaps we could see that change. But it is always worth asking. Some of these programs are looking for pilot areas as well. So like Ecosystem Services Market Consortium has a pilot program in Kansas. So I would be surprised if they aren't interested in doing some type of grasslands pilot as well.
All right, we'll take one more here.
So last one for now. Is there any difference in carbon sequestration for irrigated versus dry land?
Yes. So this is a great segue to the agronomy side of things. Carbon sequestration is highly dependent on primary productivity. Irrigated land is generally going to be producing much higher yield per acre. So greater biomass usually leads to greater carbon as a general rule of thumb, and greater turnover as well.
Greater decomp, with greater moisture comes greater decomp.
There you go.
Say that.
With greater moisture also comes greater decomposition.